Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And welcome. This is the Investor Coaching Show. I'm Paul Winkler, talking money and investing. Talking about the news of the day in the financial world, what's been happening out there, things you may be hearing about, how to put them into perspective, and also just walking through a little bit of education on the financial world. You know, some of the things that you may not necessarily hear from the industry because the industry is so driven by product sales and pitches. And that's just one of the things that drove me away from the industry so many years ago. You know, it's a lot of times that people want to come in and they say, hey, we want to work, we want to work with you. I've had younger people that want to do that. And I'll start to ask them questions. And I'll call it the only way that I could ever work with somebody, you know, as in educating and bringing them through is you got to empty you of the investment industry garbage that you've been trained in. You know, so often what happens, people go to work for big investment firms, go to work for investment firms that you hear advertised all the time, or they go to work for insurance companies, and they have so bought into the product mentality and the investment mentality that is taught at these firms. I mean, that's basically what drove me crazy, is so much of what I was hearing from management just didn't play out in real life. You know, you got to buy this, Paul, this fund is a really good fund. You ought to be recommending this fund. And that fund would go and crash in future years. You know, you need to use insurance, you know, life insurance. It's great investment. You need to use it as a tax-free kind of a Roth alternative is, you know, in later years how they actually marketed it. It was a Roth alternative. But the idea is you put money in, it grows without tax, and then you can pull it all out tax-free. And they didn't really explain the other side of the story, which is it was really bad as an investment. You know, it had all kinds of downside risk, all kinds of risk of actually ending up with huge tax bills later on. They just didn't explain that. Or annuities, the bad taxation when it came down to annuities. When you actually look at how the last in, first out tax rules work, it can be awful for people inheriting or trying to use annuities for retirement income. You know, so a lot of this stuff just, you know, it slips by because hey, whatever it takes to get people to buy this thing, that's what we got to do. Yeah, so that's the approach here. There was, and more about that in a second, they were talking about the data on cap-weighted indexes this week. So when you have an index fund, let's say it's a fund that is tracking the S&P 500, or it tracks, let's say, the Russell 1000, or Russell 1000 value, or, you know, Russell 2000, or the Wilshire indexes, or anything like that. Most indexes are cap weighted. And what that means is weighted by the capitalization of the company. And, you know, let's say that I look at a capitalization. What does that mean? Well, let's say that I wanted to buy an entire company. I like the company so much I wanted to buy the entire thing. There was an old commercial, I think it was an Norelco commercial years and years ago, and they would talk about, you know, when you're buying this guy liked Norelco so much he wanted to buy the whole company. So you take a company, the shares outstanding. So when we take a company that's $1 million company, let's say, just to use a nice, really simple example, and let's say that we issue 1 million shares of stock. There are 1 million shares of stock issued on this particular company. It's $1 million company. There are 1 million shares issued. That means it's divided up into 1 million parts, and each part would sell for $1. So if I want to buy one share of that company, I put down $1, and I own 1/1,000,000th of the company. And, you know, hence, if that company goes up to 2 million, my $1 becomes worth $2. Now, you know, I've doubled my money, but I still own 1/1,000,000th of the company. So that's just the math on it. Now, if we look at cap-weighted indexes, they are weighted based on the size of the company. So if I have one company in an index fund that is worth $1 million, and I have a second company in that index fund that's worth $500,000, you're going to have twice as much of your money in the $1 million company when you buy that index fund as you are the $500,000 company. So it's going to be weighted based on the size of the company. And that's the big issue that we've been dealing with recently, is where you got upwards of almost 40% of your money when you own an S&P 500 fund. You have almost 40% of your money in just a small handful of stocks, like 10 stocks. So you look at that and go, wow, that's a big concentration. And it's a concentration it's not unprecedented, but it's pretty doggone high. So a lot of people have a lot more risk than they necessarily think that they have when they own these index funds, is really the issue. So they were giving some statistics regarding this on one of the financial channels. So, basically here's what they had to say.
What about earnings season? I mean, the fact that the market has basically gone almost straight up just over the last few months into an earnings season where expectations are high, you think that companies will be able to deliver?
Well, it depends on the
I mean, that's a good question right there. Do you think the companies will be able to deliver? When we look at what drives stocks up, it is not necessarily the earnings in hand that drive the price of a stock up. It's what we think the earnings will be in the future. So if I think a company is going to do well in the future, I am willing to pay a high price, and I have to pay a high price today, because somebody that owns the stock is not going to let go of it for a cheap price, because they're giving up those earnings that are going to come in the future. So people will pay up now for earnings that might come in. Now that's the question, is will those earnings actually come to fruition? So
they'll be able to deliver?
Well, it depends on the company. So, yes, if you talk about the market at the index level, it's gone straight up since the April 8th closing low. The difference, though, is what's happened under the surface.
And that's a point right there. If you have most of your money in just a small number of stocks because you own an index fund that's weighted based on the size of the company, like I said, you have 40% of your money in 10 stocks, let's say. What about the other 490 companies in that index? What have they been doing is really what she's bringing up right here. So back to it.
Closing low. The difference, though, is what's happened under the surface. In the last 6 months, you only have 23% of the constituents within the S&P that are outperforming the index itself.
So only 23%, a very tiny percentage, are doing better. So that means that almost 80% of the stocks in the S&P 500, 80% of them almost have a return that is lower than the index, which tells you that it's that top 23 that's carrying the weight, is what she's basically saying. Fairly precarious if most of your money is in those few companies that she's talking about right here.
So you've had a lot of churn and rotation under the surface. The average member within the S&P, just since April 8th, has had a maximum drawdown of 15%. It's negative 35% in the case of the NASDAQ. So I think the fuller story of what's happening in the market gets told under the surface of these cap-weighted indexes.
Yeah, that's a big deal right there. How much of the movement of the market is just due to a few companies that just most of your money is in just because of the way these things are designed. Now, a lot of times people hear my show here and they think, Paul, you don't believe in stock picking. Nope. You don't believe in market timing. Nope. I think it's a bad idea. So just index the portfolio, right? And I'm, nope. The indexing works in a couple areas, but it doesn't work in a lot of areas of the market because you have this overweighting. If I'm looking at a small company fund, and a fund that's investing in smaller companies, I'm doing it because I want the return of smaller companies. But if they're overweighting big companies, that's a problem. If I'm buying a value fund, by definition, those should be lower price companies. But they're overweighting higher price companies compared to book value. So, matter of fact, one of the questions that came up on Channel 5 this week was that. They were asking me, Paul, what do you do? How do you do this? And I said, well, I'll tell you some things, but it's above the pay grade of the average investor in there. I just want you to understand a little bit about this works. And if you know a little bit about how this works, then once your investment portfolio is set up, then you don't worry about it as much anymore. That's really the reason for my teaching so much. I'll never forget a doctor saying that to me one day. You know, he got in here, he's coming in for a review, and he made the comment to me. He says, you know, I hear you talking about this. And he says, can you explain this? And I explained something to him over again. And he goes, yeah, I remember that. He says, you know, let me tell you something about me. He says, I have enough respect for my intellect that I know that when, you know, I have enough respect for my ability to reason, my intellect, that if something made sense to me when I made the decision to invest in it, that I'm okay with it now. And he says, I may have forgotten some of the things that you taught me, but when I understood what I was doing and why I was doing it and made that decision, I don't look back and have to worry about, did I make a good decision or not? It made sense to me at the time, and I'm good with that. And I'm okay with that. I thought, oh, that's a really good way of looking at it. You know, it's like so often with so many things that I believe. I have found that. You know, there are things there are things that I believe that I look back and I go, well, why do I believe? You know, for example, I'll give you an example of capitalism. You know, why do I believe in capitalism? Well, that's probably a bad example because I remember most of the details on why I believe that. I have to think of something else. But if I have certain beliefs, I probably analyzed the daylights out of it before I made the decision. You know, like for example, let's say, I'll give you a good example. You know, faith and you know, my Christian beliefs. Let's say I'm just going to step out there and say that. If you look at, well, why do I believe what I believe? Well, I was as analytical as the day was long when I was making that decision. I looked at science. I looked at apologetics. I looked at you know, I looked at archaeology. I looked at history. I looked at, you know, how things were passed down. And I made that decision based on the logic of it. It made total sense to me. And then, you know, a lot of this stuff, I'm going to tell you, I've forgotten. There's some of the things I've forgotten, some of the details, some of the data. But it made sense to me when I made the decision. And that's the same way I look at this particular thing. When I look at investing, you know, I may talk to you about price to book. I might talk to you about price to earnings ratios. I may talk to you about, you know, out of sample data when it comes to investing and how different markets and how robust the data is from one market to another. And, you know, all of that stuff you may be going, I don't even know what you're talking about. But typically what I do is I spend enough time with people in the very beginning to understand why the data is what it is when it comes to value stocks, why the data is when it comes to small cap stocks versus large cap stocks, why the data is what it is when it comes to international versus U.S. And I will actually walk people through that in a way that they go, I get it. And people will say this to me all the time. I get it. I couldn't explain it back to you, but it makes sense. And what I find is that when people are at that point, they know it makes total sense and it's logical, but maybe they can't explain it back to me. They will be a more sticky investor. They won't be pulled by every sway of the wind, by every new headline that crosses the TV screen. They won't be pulled away by it. And I think that's really what's key here. And basically what she's saying here is that, you know, you have the cap-weighted indexes and there's some weird stuff going on. And the indexing isn't necessarily the great, and I have a whole workshop on why I don't use indexes, except for in a couple asset classes, a couple areas in the market. And it's because of this. And
therefore earnings will be better absorbed or don't have to clear as high of a bar?
Well, I think down outside of the mega cap areas, you probably have a reasonable expectations bar. I think most of the increase has been concentrated in those higher momentum mega cap names.
And that is key. Because you're hearing people saying that the market's overpriced, the market's overvalued, it's getting ready for a crash, it's a bubble, and you keep hearing people say that. And you go, well, is it everywhere? And she's like, no. Most of the returns, most of the momentum, most of the big jumps in value have been with a few names out there. If you're a more diversified investor, now, God help you if you're an investor that's really concentrated in these names. It could be a real problem going forward. If they don't if they don't meet their earnings expectations. If we think that their earnings expectations are going to be really, really high, that these AI companies are going to knock it out of the park, and they come in and they have really a great year, but it's just a little less than what was expected, they're coming down. You got a problem on your hands. So that's what she's talking about right there.
I think the possibility or the risk is there if you get any kind of negative release. That said, I think the opportunities still look pretty decent. Valuations are not as stretched if you go down below the initial surface of these cap-weighted indexes.
And that's the key. That is true diversification. And unfortunately, a lot of people aren't that well diversified. I will often do that. I did, I talked about that a little bit earlier, where you go through, look at these asset allocation funds for these huge mutual fund companies. And you see that 70% plus of the money is in big companies, 2 to 3%. 3% was the highest that they had in small value stocks. That's not diversified. And that's where the mutual fund company, these major mutual fund companies, are choosing the investment for you. They will say diversification is important. Diversification is very, very important. They said it over and over again. And I read the ads for you talking about that. It's diversified. We're diversified. We think it's really important. We got our eggs in lots of baskets. And my point was, no. They have most of their eggs in one basket and just a couple eggs in the other baskets. That's a problem. It can be a huge problem if, indeed, these companies don't meet their earnings expectations. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.